Okay, so I think we'll get started. And I know people are still coming into the room. So good evening, everybody. My name is Claire Hanrahan. I am one of the directors and the COO at Irish Pensions and Finance. I'm going to be your MC for this evening. So just before we get going onto our webinar, I just want to talk to you and give you a little bit of introduction about what we're hoping to get done this evening. Irish Pensions and Finance, we have been doing retirement seminars since 2010, and usually we would rent out a big room in a hotel, and people would come along. We would do a couple in Dublin every year, one in Cork every year, and we would travel all around the country doing seminars for our existing clients and indeed prospective clients. I suppose the pandemic has had a couple of advantages in that, this evening we can put on the webinar for people up and down the country, and it's very convenient for them just to log in and sit down and get the information that we have to give them. So that's absolutely brilliant. I suppose, look, this evening it's one of the biggest number of attendees we've ever had, and that's I think there's a few reasons for that. Obviously, there's the convenience part of it, but from speaking to colleagues, clients, and even family members, I think over the last couple of years, people have had a lot of time to think about what's important to them and indeed about their careers, and a lot more people are considering retirement than ever before. So I think that's what we're hearing. And so this evening, what we're really hoping to do is to give you some great information for that journey. Now, before I introduce our panelist speakers, I just want to go through a few housekeeping bits and pieces. So look, the webinar is going to last about an hour, and please take notes, obviously, but we will be sending you a copy of the slide decks after the webinar. As well as that, I suppose we've had hundreds of questions in over the last couple of weeks, so we're not going to get to them all this evening. We will cover a lot of the questions as we go through the slides. But if you feel, look, they actually didn't cover the questions that I sent in, you're more than welcome to arrange an appointment with one of our financial planners after the seminar, and they'll absolutely be happy to help you with your query. Just from a technical point of view, the chat function is going to be off for the majority of the webinar. There'll be a few times that we're going to switch it on, and we'd love participation from the attendees. So we'll let you know when we're about to turn on the chat function. And last thing is as well, before I said I'll introduce the panelists, we have a competition. So we have a €150 all for one voucher up for grabs. The competition, we're going to do it at the end of the webinar. So at the end of the webinar, we're going to put up a question about a piece of information that we gave out during the webinar, and the person who puts the right answer in first will win the €150. Is that okay? So without further ado, I'm delighted to introduce to you the panel that we have this evening. Well, firstly, I have to say thank you. Sarah Connolly is our marketing manager and our producer, and we couldn't do it without her. So thanks for all the work you've put in, Sarah, to organising this evening.
Thanks, Claire.
Yeah. So one of the first speakers up is going to be Colin Whelan. Colin is a certified financial planner. He's with the company 8 years, so he's got some really good information for you. Following on from Colin, we have Ellen McElroy. Ellen is sales manager. She's QFA'd. She's been with Irish Pensions and Finance for 12 years. From there, we've got Neil McGuarty. So Neil has been with us 10 years. He's a CFP and a regional manager with Irish Pensions and Finance. And then finally, and last but not least, we have our founder with us today, Owen Dwyer, and he's our CEO. And I think, Owen, you've got something big happening this year that it helps you relate to the attendees this evening.
Yes, Claire, I'm retiring this year myself in October.
Great. So we're looking forward to seeing what you have to say when we get to your part of the presentation. Okay, so I think that's all the bits and pieces to get out of the way. So I'm just going to go on to the next slide. Yeah, so as I said, we've Colin Whelan up first. He's going to talk to you about where you will stand financially in retirement. And then what we're going to do is we have the panel. So there's Ellen, Neil and Owen are going to talk about building a financial plan for your retirement. So that's what we're going to do there. But before we go over to Colin, I just want to get everybody in the pensions frame of mind and get comfortable with the chat function. So we have a few little questions to get you going. So if everybody wants to use the chat function. So the first question is, for every one person retired today, there are 6 working. In 2050, how many people do you think will be working for every one person retired? So 4, 3, 2, another. Oh, look, the answers are flying in. Great. So everybody's getting comfortable using the chat. Have we got many right answers there? Well, the right answer is 2. So how do we get on, Sarah?
Yeah, loads of 2s there, but pretty much spread across the board, Claire. So yeah, I think, yeah,
Good.
loads of different answers there, but loads of 2s. Yeah, well done.
2s. Okay, so yeah. Okay, great. Life expectancy has greatly increased. How many years do you think the average person is expected to live after they retire? Okay, plenty of answers coming in there. And yeah, thankfully to all our friends in the HSC, it's 20 years. So that's great. Okay,
yeah,
2 more questions.
Most people seem to get that one there. Yeah, well done.
Yeah, they did. Yeah, they're all feeling good, feeling like they're going to last another 20 years. Great. We go on to the next one then. So 2 more questions. Okay. What percentage of your salary will revenue allow you claim tax relief on through pension contributions at the age of 60? So is it 20, 30, 40 or 50? Once again, it's great. We've got loads of people participating this evening, so delighted to see that. So the answer is actually 40%. So I think Ellen's going to talk to you about how you can use that 40% when we get to Ellen's part of the presentation. Last thing is, okay, what is the average interest rate given on a deposit account? So any guesses for post office, bank? Oh yeah, all the zeros, all the zeros are there, Sarah.
Loads of zeros. Yeah.
Owen is going to talk to you about how you can make your money work for you in retirement. So the answers for that were 0.15% with the post office and 0.5% with the bank. Okay, so once again, thanks everybody. Just wanted everybody to get comfortable and relaxed and in the frame of mind for retirement planning. So without further ado, we're going to move on to Colin Whelan.
Hi, Claire.
Hi, Colin. So what are you going to be discussing with us this evening?
I suppose there's going to be some important areas that I want to go through that from a financial planner's point of view are really, really prevalent that we actually touch upon with our clients. We basically want to make sure that our clients are planning for their retirement and the retirement that they want to have. I suppose every client will have their own objectives and their own needs, and it's about making sure that you put a plan in place to allow for these to happen. So I suppose what we're going to concentrate on, Claire, is the before retirement, the after retirement, and the after. The before is going to be about the planning, the after is going to be about putting things in place, and the after is going to be about maintaining that plan and making sure that it's doing what you wanted it to do.
Okay.
So I hope that's quite clear and hope people get something from this.
Great. Okay, so look, as I said, Colin and all the panelists, I'm going to bring in a few of the questions that we've had from our attendees this evening as we go. So we had a couple of questions in, Colin, about public servants that they said, like, I'm paying for a pension contribution, like what benefits do I actually get from it?
Yeah, and I think this is really important because before you do anything, before you put any sort of plan in place, you need to know what you have. And once you know what you have, then that allows for you to say, okay, look, this is what I have, this is what I need to do to get to a certain objective, a certain fund to allow for my objectives. So I suppose just to kind of go through these with the audience then, number one, guys, you'll have a pension. And the pension is payable from the day you retire till the day you pass away. And that pension is taxable. Okay, we're going to talk about tax in a few slides' time because it's very important. And then secondly, then we have a lump sum, that's a tax-free lump sum, up to €200,000, just to get that across. And that's a once-off payment made the day you retire. There's three
not every year, Colin, as someone asked.
Unfortunately not. You like Christmas. But yeah, so look, there's 3 other benefits as well that are quite important. So if you can't, if you don't make it to retirement due to ill health, there is a benefit payable to you if you have to retire due to ill health, and God forbid that doesn't happen. And then the last 2 benefits are all about if you pass away before you retire or after you retire, there is a benefit payable to your families. And so they are quite important. I suppose, Claire, just to get across, right, as part of our consultation process, we make sure that every client understands exactly what they have.
Yeah.
As I mentioned later on, it's really important to know what you have. But everyone's situation is different. So all these figures, the figures for these will be different for every client.
Okay.
So just to get that across, the consultation is really, really important.
Great. Now I had a question, Colin, in from Kathleen from the HSE. She said, there's an A on my payslip and I don't know what that means. So can we explain that to Kathleen?
I like that question, a very simple question, isn't it?
Yeah.
Yeah, I suppose, look, there's 4 schemes within the superannuation scheme as a whole, okay? And you can see I brought them up here in the slide. And we have people who started before April of 1995, and they'll see either a D, a B, or a C on their payslip, as per what Kathleen said about the A. And I suppose it's just important to note that these particular cohort of people, they're not paying much of a PRSI stamp. They're not really getting much, well, they're not going to get a state pension, for example. There'll be no real health benefit payable to them either. But they do get a bigger employer pension, so we'll talk about that as we go forward. So it is a really good scheme, okay? Just to get, I suppose I should say...
Cody, just to make the point, there will be an ill health pension paid to them from their employer, but they might not get a state disability pension. I think that's what you
Yes, that's correct indeed. I'm sorry, make the good point. It's a social welfare aspect.
In case we panic people.
Sorry, yeah, good point. And it's, what I'm coming from here is from a social welfare point of view, which is what the PRSI is all about. So look, the A class stamp is for people who joined after April of 1995, and what they're paying towards is a state pension. So they'll get a piece of employer pension, a piece of state pension. We're going to go through that in detail as we go along. So I hope that's answered Kathleen's question.
Yeah, great.
Just to move on from that, Claire, right? I think it's really, really important that there'll be people in the audience today, right, who will be part of the post-2013 scheme. And the post-2013 scheme, right, as the schemes change, okay, as the schemes go on, there's 4 different schemes. The schemes are getting a little bit different every time.
Yeah.
The post-2013 scheme is actually majorly different to the schemes that, you know, that are previous to it. So, for example, right, the D1 stamps, the guys who started before April 95, they're going to get 50% of their salary as a pension when they retire if they have full service, okay?
Mm-hmm.
However, for someone who started post-2013, the figure could be 15% of final salary. So it's a big, big difference, okay? And something we need to make people aware of. And the rationale for that, as you can see from just the point 1 here, is that there's now a career averaging system in place for anyone who joined after January 2013. The career averaging, what that means is that your pension benefits will be based on your career average salary. So it's really, really important to get that across. Just another point to be aware of, that the normal retirement age for the post-2013 scheme is now going to be linked with the state pension.
So if that goes up, your retirement age goes up.
Bingo, yeah. So we're going to do is, right, we're going to talk about the state pension later on in a few slides' time.
Okay.
They're the main points to take away from the post-2013 scheme, and I just want to make people aware of that.
Very good. Now, like, of the many questions we got, okay, there's so many of the attendees, they're not going to have the 40 years, Colin, and they were wondering, like, what impact will that have on their lump sum?
Yeah, okay, so I think this next slide will help with that. Sorry, 2 seconds there. We'll go back a slide. Getting ahead of myself. Okay, lovely. So just to give you a bit of an example here, guys, okay, so the way it works is that if you have a career average salary or a final salary of €50,000 and you have your full service of 40 years. So say, for example, Anne has 40 years worth of service. Well, Anne, you're going to get a lump sum of €75,000 tax-free the day you retire.
Yeah.
However, we might have Peter, and Peter could be part-time or whatever it might be. He might have come in service late, job share, whatever it is, right? And he may only have 20 years service when he gets to his retirement age.
Mm-hmm.
So his lump sum will be €37,500. So half, okay? So it's a pro rata basis.
Yeah.
More service you have, the bigger lump sum you get from your employer. And the great thing is here, right? Sorry, go on. You want to ask me?
Yeah, no, and I think Ellen's going to cover a lot of the, you know, the reasons for shortfalls in service in a few minutes as well.
Yeah, and what you can do as well, I think Ellen's going to touch upon as well. Like, so, like, you know, this is where the ABCs and stuff like that will come in to try and actually help you to get your full lump sum, very tax efficient. So I'll leave that to Ellen. I won't steal her thunder.
Oh, okay.
So,
great. And then I suppose regarding pensions, then what way does that work?
Yeah, exactly. So like it's obviously a good thing to move on to pensions now. So regards to the pension, so using the same example here, right? So we'll stick with who I said Anne and Peter, wasn't it? Okay.
Yeah, Anne and Peter.
Thank you. Yeah. So we'll stick with those names, right? So not to confuse things. So just to say, right, so if you have a final salary or career average salary of €50,000, once again, if you have your full service 40 years, however, and 40-year service, excuse me, right? However, if, say, Anne was on the D1 stamp with her 40 years and a final salary of 50 grand, she will get a pension of €25,000. Okay.
And Colin, where does that come from?
That's payable from her employer. Does that make sense?
From only her employer, okay.
Only her employer, yes. So there's no state, no, Anne's not paying a stamp to allow for a PRSI stamp to allow for a state pension benefit. So just to be clear on that, okay?
In this example, yeah.
Yeah, exactly, yeah. However, we have Peter. Peter is an A1 stamp, okay? So he started after April of 1995. He has 40-year service. He finishes up on a final salary or a career average salary of 50 grand. However, his pension is going to be a lot less than Anne's. Now, let me just be very careful on this point here, right? Because Peter's pension from his employer is going to be 11,783 per annum. However, he will qualify for a state pension,
provided he has full stamps and stuff like that. So I mean, you know, I suppose we're given pretty general information here, and you know, things can vary on a case by case basis. So
yeah, a few more hoops to jump through. But yeah, exactly. So we just want to be quite clear here. Look, the employer pension will be a little bit less, but there will be a state pension benefit applicable at some stage.
Yeah, and I think, look, this is kind of, you know, for illustration. If they sit down with one of our financial planners, we'll actually be able to, you know, give them a good outlook of what they're on track for.
Yeah, that's exactly what we do as part of our process when we sit down with our clients, our consultation process.
Great. Okay, so we discussed death and service, spouse and children scheme. I see you have a slide here, Colin, for life cover in retirement. And I suppose in my head, I'm thinking, sure, like, I'm retired, why would I need life cover? Yeah, well, look, yeah, well, that's it. Like, and I think like our situations change, like there's sometimes we have, you know, our reasons for having a certain, like a benefit of some sort will come up or not be there at all, maybe. But just to give you a bit of an example here, right? So I'm lucky enough to have a 3-year-old and a 1-year-old. Now, I really want to make sure that if something happens to me, that they're looked after. The biggest thing in my world is my children, okay? So I really want to make sure they're looked after. However, right, I have my mother and father who are in their 60s. They have a 37-year-old, okay? I know I don't look it, right? As well as a 31-year-old, okay? So, but they don't, like myself and my sister, we're financially dependent, thank God, right? And you know, we're not reliant on our parents anymore. So my mom and dad don't need to have the life cover to make sure that that makes sense.
Do you know what I mean, right? So, however, it could be a case whereby a person gets to 60 or 65 there, right? And they're retiring, but they're caring for an elderly relative, like say those words, right? So it may be a case that if they're no longer around, they want to make sure that there's someone there to look after their loved one. Yeah. Do you know what I mean? So there might be a case there for saying to someone, look, this reason here is gone, but there's another reason over here. As well, we're considering that. Now, there's another area, Claire, to be very aware of, and that's the inheritance tax area. And you know, if you have large estates and stuff like that, and we want to pass those down to our kids at some stage, there may be an inheritance tax bill, and that's where life cover can come in again to try and offset a portion of that, or all of it, if that makes sense. Okay, so look, it's something that, you know, we can talk to a client about if there's a need for it. Yeah, pre-retirement, that retirement, post-retirement, it's all about the process and understanding what you need when you need it. Brilliant. Okay, so then, now we definitely had a good few questions. Fiona in St. James's, Colette in Tusla, they were asking about, is my pension taxed? So have we good news or bad news, Colin? Well, like, I think, like, I suppose it's hard to say, Claire, everyone's different in this situation. So once again, like everyone is different. We know that everyone's situation is different. Everyone's pension will be different. Everyone's salary will be different, right? So what we can try and do as advisors is to try and make sure that you pay as little tax as possible in retirement, okay? And that we can, when you're actually planning for retirement, so pre-retirement, that you're actually offsetting your tax bill as much as possible to try and build like a big enough pension pot for yourself that's going to allow for your needs and your objectives in retirement. That's the crucial part of the game, right? So what we can try and do, so say if you're amassing a pension fund, okay, and you're putting monies in, and you're putting as much as you can in, you're getting good tax relief, we can try and get you as much of that as tax-free as possible when you retire. Okay, so that's the first thing, yeah. 100%, yeah. We would like, that's the most efficient way of doing things, get you as much tax-free as possible. Great. However, the balance is going to be taxable. So a pension is an income, so it's taxed. Exactly, right. And you're taxed the same way you are pre-retirement as you will be in retirement. So you'll see here, Claire, there's a few cut-off points and tax credits that are there.
Yeah.
We can try and move these around to suit different people's situations
Okay.
in retirement. You could get 40% tax relief putting monies into the pension fund before you retire, and after you retire, you may not pay even 20%, but everyone's situation is completely different.
Great. And I think Neil is going to talk to us a little bit about, the management of your money post-retirement as efficiently as you can, I suppose.
Really important area, really important area. Okay.
Brilliant. Now, there was definitely a few questions about entitlements in retirement, Colin.
Yeah, like I suppose this area is look, if you can take advantage of what's on offer to you, do. Simple as that. As the main thing here, we're going to talk a bit more detail about the state pension, but there's other potential benefits for retirees. And so I've listed quite a few of them here. Now, it could be a case that you're not eligible for these until maybe your 70th birthday, but what we're saying...
Or some of them might be means tested, might they?
Yeah, exactly. Yeah, potentially, yeah. So, I think the thing to do here, right, is you can see at the bottom there, for further information, go to Citizens Information, guys. And I can vouch for this myself because I've sent my favourite client to the Citizens Information Bureau. And who's that? That is my mother. Not my best client, but my favourite, all right? So I sent her there and they were fantastic with her. She made an appointment. She went down.
Okay, great.
Through what she could do, what she couldn't do. And she came back and said, look, I don't want to say, she was derogatory towards me, but she was very happy with them.
Okay, so that's a good website to visit, and that'll be going out in the slide decks to the clients anyway, so brilliant. Okay, so a couple more bits from you, Colin. So we had Anne from Mayo. She was just asking about qualifying for social welfare pension and when she would get it. She's on A. So what can we say to Anne?
Yeah, I suppose, Anne, it's very hard for me to answer this question for you. So I can give you an understanding of what the situation is at the moment, and I'll also try and give you an understanding of what's gone on previous, because this is a very much evolving area and quite political. People don't want me saying that, but it can be quite political. As things stand, right, there was meant to be a scheme that came in place in 2020, the total contributions approach, and as part of that, for anyone born after January 1961, they weren't meant to get the state pension until they were 68. Now look, that didn't come in, okay, and so the situation at the moment, Claire, is that you can actually apply for a state pension from 66 at the moment. Okay. But just to say this to everyone, there is a payment payable through social welfare that will see you through from 65 to 66. It's not the full state pension. You can't be working while you're claiming it, but there is a payment there that you can avail of from social welfare. It's all about engaging with the social welfare department to make sure that you can actually get. Some people don't realise this. I had one client on to me the other week, and she didn't realise it. So just to make sure people are aware of it.
You bring it up with your PPS number, or logging onto that website, and
yeah. It's important, I suppose. Just on that point, actually, it's you can use the MyGov website. I think it is, and what you can do is you can actually use. I might go through this in a slide or two, actually. I think, but just to mention, you can actually get a statement of your PRSI contributions to make sure you're going to qualify for your full state pension. So I think how do you qualify here? Just that. I won't go through this in detail, but it's just worth knowing how you qualify. Okay.
And then I suppose you have this slide here. Okay, so the contributory state pension, and that's the rate, and that can change at every budget. What's a maximum qualifying adult rate? I wasn't quite sure.
Yeah. So this is a pension payable to your spouse. So say, for example, you're 66, you're claiming your state pension of $253 and 30 cents per week. You may have a spouse who's maybe 61, 62, whatever age the spouse is, but there is a pension applicable to your spouse via the state if you're claiming your own state pension.
Okay, that's interesting.
Yeah, it is interesting, right? However, it is means tested.
Okay.
So just to bear that in mind, it may not, if your pensions are to a certain level, you may not qualify for it.
Great, that's great. Thanks.
Again, and then information. Simple as that.
Yeah. Now, there was also with Thomas from the local authority. He had a question about, he had a private pension, and then we a lot of our attendees here this evening have worked in the UK, especially within the health service. So what is this website and how can it help them? Yeah,
I suppose, look, this website is all, you can see here the things to consider, right? This website is for people who have either previous, existing or concurrent private pension benefits, and they're unsure as to how they're actually going to, or pension benefits from abroad, excuse me. They're unsure as to how they're actually going to benefit from these? When can they get their hands on them? How much can they take tax free? You know, there's all sorts of different questions. What's taxation on the balance?
And so it could be like some spouses of the attendees this evening might, you know, not be as well looked after as a public servant when it comes to their pension planning.
Like some spouses may have worked in the private sector all their lives, but they worked in maybe say different companies, and they have maybe say 3 separate pension pots sitting, and they could access. They don't know, can they access at 65 or 60, or what age can they get their hands on these monies? And
great.
You know, so simple. Like the retirementclaimant.ie website is something that we refer these clients to, and this is something that we will then we'll get back to them and try and help them out the best possible can.
Brilliant. Okay, and then I think in advance of the, I'm just changing the slide here now. So Colin, in advance of the webinar this evening, we gave the attendees a little bit of Oberwalya, bit of homework.
Oberwalya, I like it, yeah.
Yeah. So why do we do this?
Yeah, I suppose, look, the reason, like from an advisor's point of view, and when I'm sitting down with my clients, like, you know, it's very important that our clients understand what they'll actually need to have the retirement that they want to have. So budgeting is a massive part of this. I'll say, so what do you think you'll need as an income in retirement? And God, it's an awful question to try and answer if you haven't done this exercise.
Yeah. So
it's really important, I suppose, that this is brought, you know, this is the factor in your thing.
So what tips would you have for completing this little budget plan?
Yeah, okay, cool. So the 4-week rule, okay. So essentially what I'd like my clients to do is to try and track their expenses, their expenditure. And there's simple ways of doing this now. We all have the tap cards now that you can tap for anything that you pay for. And you know, you can follow through your bank statement. If that's not, you know, if that's not doable, you can write everything down that you actually pay for. And then just to dissect that at the end of the month and to understand where your money is going. And that will give you a really good understanding as to, okay, well, look, the mortgage is going to be gone, so that's not going to be a player. But I am actually going to have my VHI.
Yeah.
And then as well as that, guys, it's worth considering in the future whether or not you're going to need monies for, you know, maybe doing up the house or whatever it might be in the future, like
changing the car, things like that.
Exactly. Yeah. So
and I think Owen's going to talk to us about, you know, the various pots of money you're going to need at various times in retirement.
Yeah, absolutely. Yeah.
So I think what would you advise the clients to have this completed if they could before they sit down with an advisor at IPF?
Yeah, definitely. Look, it'll make things easier for them and make things easier for us to try and put a plan in place for them. So absolutely. Yeah.
Brilliant. Look, that's been great, Colin. So what's your headline tips for our attendees here this evening before we move on to the panel of Ellen and Owen?
I was trying to think of this, so it's like, think of something like alliteration, so using alliteration. So I'll talk about the 3 Ps, okay? And my last P is a bit of a cheat, but anyway, right? So it's all about prepping, planning, and putting in place, which is really implementing, okay? So PPI, if you want to put it that way. So that's a good thing. So I'm just engaging in the consultation process. Like that's what that is all about, engaging in the consultation process. Great.
Look, thanks so much for that, Colin. So now we're going to hand over to our panel. So we're going to discuss building a financial plan for your retirement. Okay, so we've got Ellen and Neil and Owen, and I've already introduced our speakers here. So I'm going to start off with Ellen. Ellen, what's this that we're looking at here?
Hi Claire, and good evening everybody. I hope you're finding everything very informative so far. Yeah, I mean, what I'd like to do this evening, Claire, is to bring you through the process that we usually offer our clients in the run-up to retirement. And we had a question in from Mary from the HSC in Galway, and it's a really good question. And I suppose a lot of this evening, guys, is linked around, you know, your finances, and it's so important that we think about these things. But what are the other things we need to think about in the run-up to retirement? And I suppose the big thing here, guys, time frame, as Collie was really reiterating earlier, timing is really huge in this process. So timing could be, look, how far out do I see myself retiring? And also, what do I need to implement in the time that I have left to retirement? You know, and
because we had a question from Jennifer and Sutton, who was wondering, like, how many years out from retirement should I start to plan?
Yeah, do you know what? It's a brilliant question because, you know, and I know we keep saying it's different for everybody. Everybody's circumstances are different. Like we would have clients in their 20s and 30s and they're planning for their retirement, Claire, you know, so the further out you plan, the you know, the easier it is that you're going to land in a place that you might want to land, you know. And also as well, from the glide path process that we recommend everybody engages with, 5 years out really gives you a great opportunity to get all your ducks in a row. And also as well that, you know, you have an opportunity to kind of look at the areas that are important to you. So there's no surprises when you get to your chosen retirement age. Timing, it's such a big thing for everybody to consider, you know, and as my mother always says, how do you know when you're ready to retire? So her take on it is, look, instead of lying about your age, you start bragging about it.
Okay.
You know? So
I like it.
The message here is, look, I would talk to clients day in, day out about retirement, and when they feel they're ready to stop and what they want to plan for. You'll know in your heart and soul when you're ready to stop, but the plan is really key here when you need to implement things. Like as you approach retirement, guys, there's several issues that you need to take into consideration. So up to, at, and after the event.
Okay.
So the retirement process, Claire, that we kind of recommend, it takes you step by step through this process, and it helps you make the decisions that are right for you. Okay, so look, like our leader, our managing director, if we could just go back a slide there.
Oh, sorry.
You're grand. I had to get this in, Owen. Owen is retiring this year, and you know he's been our leader for a long time, but I can just picture Owen in his little plane, flying his plane in the direction to retirement. And I'm sure Rita is delighted, Owen, as well, that she's going to have you all day, every day. But I suppose I thought this picture was, you know, a fairly kind of accurate description as to the type of journey you want. So look, what kind of journey do we want to have, guys? Do we want a smooth, clear, direct path where you know exactly what the target is and where you're going to land? Now, that could be financially, that could be psychologically, but again, it's a really, really clear picture and plan that you have. Or do we want the uncertain, turbulent route, which leaves us way off target for where we need to land? So again, it's just something to think about. It's something to be, you know, prepared for. And again, where possible, there's no surprises when you get to retirement, you know.
And I think the fact that, you know, people have taken the trouble to log on this evening means that they're starting planning, if they haven't started already.
Absolutely. And look, if there's one thing you can take away from this evening, guys, really it's to have the correct plan for you, you know. And again, everybody is different and everybody has different needs, wants and aspirations, but let's find the plan that's going to suit you. Okay,
great.
So if we click on to the next slide, and this is again, Owen, this is a very, very good image of yourself. And by the way, this is Owen on the right at one of our Christmas parties, for though. But look, guys, I just would like to get a little bit of interaction going if I can. So there was a survey conducted by businessworld.ie in conjunction with Standard Life in 2019, where they asked 1,000 retired clients what was their idea of a good retirement. So I just want to open up the chat room just to kind of get a little bit of interaction going. And guys, just throw up whatever, you know, your idea of a good retirement.
So what they'd like to see happening, or what
they'd like to see happen. What does a good retirement mean to you guys?
Travel,
comfortable living,
yeah,
being content, good health and wealth,
health, yeah,
enough money, security, holidays, time for hobbies, travel, improve my hand.
Oh, the golf player there.
Good health, being healthy, travel, health, holidays, active travel. Brilliant. Enough money for life, travel, comfortable lifestyle and health. Great. These are all great answers, guys. So just to go through.
Somebody said not skimping on the heating there, Ellen.
Oh, very good. Oh, well, you know, to be insecure enough to think of further goals. Trip to New York, brilliant, brilliant. Man after my own heart. House retrofitted, so I'm more. Mortgage paid, money for hobbies, brilliant. These are all great answers, guys. So I just want to go through the top 5 answers. So if we have a look here, so financial comfort, doing the things we want to do. So being able to do the things I want to do without worrying about money. So whatever that means to you guys, look, there's a lot of people coming in, they like to travel, or, you know, going for dinner, going for coffee with your friends. And remember, a very good point, we were talking about this earlier, Claire, that we've a lot more hours to fill during the week.
40 more hours in the week to fill.
Absolutely. And I know when I'm off on holidays, I spend a lot of more money than I do when I'm working. So again, it's just to have a think about this from your own situation. The next one, guys, is financial security, covering the essentials. And a few people actually mentioned heating there. And you know, I suppose the cost of living is increasingly going up in this country. So again, it's not to have to worry about covering the basics. So and
like if you're spending more time at home, you know, and you want to turn on the heating, like
100%, absolutely. You know, and like our expenses today will still be there when we retire. And for most of us, look, our mortgage will be gone and hopefully the kids will have flown the rest by that stage, but we'd still have all our day-to-day expenses, our VHI, our home insurance, car insurance, food, shopping, petrol, whatever it is. But again, not to have to worry about covering those essentials. The next answer was looking after the family financially. So again, what does that mean to you guys? You know, so looking after the children, the grandchildren, being able to give the kids money, bring the kids on holiday, whatever it is. Again, it's having the security and the finances to back that up. Again, if that's what's important to you. And the next one, which again, spending time enjoying hobbies. So, you know,
there's plenty of that,
build on your handicap, absolutely. You'll have lots of time to do that, folks, or whatever it is you want to do. It's usually replacing your time with something that's going to keep you motivated and going through retirement. Again, that's the feedback we get from our clients. And last but not least, having a strong overall sense of purpose. This is a massive one.
Yeah, it is, isn't it?
It's huge, you know, because if you think about it, Claire, most of our clients, their whole life and their identity is wrapped up in their occupation, you know. So again, that's something to think about from your own viewpoint as well. You know, like I'm finished with my occupation, but there's other things I can do in retirement. Do I want to, you know, commence in a second, you know, career like our managing director is going to do? He's going to be a very famous author when he retires. But just to flip it on its head, I mean, I'm not going to go through what a bad retirement looks like, all the answers, because we'll all be depressed. But the top kind of two answers from a bad retirement, it's poor physical health, you know, so that's a big one as well. And being financially cash strapped. Okay, so they were the kind of the top two from the survey. But if you look at this, guys, I suppose the top three are linked to finances, which demonstrates, you know, the importance, Claire, of having a good financial plan now and in retirement. So look, again, just to think of it from your own situation, what do we need to fund for when you stop working? So what's important to you? Again, this is different for everybody. You know, like, do I want to go back to college? Do I want to travel? Do I have health expenses? Like my pension fund, is it sufficient to last me for my retirement? What are my bills, my family, you know, insurance, my day-to-day bills? Again, it's just, I suppose, what is important to you as an individual. So look, guys, how do we structure this? And again, back to what Colin is saying, PPI, it's all about the planning, okay? And if we look at, I suppose, our glide path process, and we introduced this, goodness, Claire, when was this? 3-4 years ago, we introduced the glide path plan. And honestly, it was a game changer for a lot of our clients. It was like night and day, because it's a very, very clear track for you to run on and to think about all the things that you need to be considering in the run up to retirement. I suppose, look, what we find, Claire, with this is that anyone that engages with us in this process, they get an awful lot more out of it. Because we're tapping into areas that you mightn't have thought about when thinking about retirement planning. So I suppose at meeting one, what we have a look at are, you know, your options at retirement in relation to your tax-free lump sum. If there's a balance in your ABCs, you know, you may be able to take some of your ABCs tax-free. If there's a balance, what are the options on those? And we'll walk you through what is the most suitable option for you. Again, because everybody is different. And then also as well, you know, revenue have rules around what you're allowed to do to contribute before you have you know, you get to retirement. Now, this is going to have a bearing on the previous point. So again, we generally cover these 2 points at the initial meeting.
Yeah, and I think what you find, Ellen, is that like you have to, if you don't do it before you retire, it's gone. So
Absolutely.
we've seen clients, you know, people in the past have left it too late and they've missed out on tax-free money, and you know, so
100%, you know, and again, it's you know, it's looking at, you know, windows of opportunity, but also as well, you know, these reliefs and facilities are there for you to utilize, and we don't utilize them, you're 100% right, they go back down the revenue dark hole, you know, where we can't avail of them. Now, usually in meeting 2, now Colin, you know, covered this in detail earlier, it's to see, you know, your death and service benefit, you know, do you want to continue that into retirement, and what are your needs going to be in retirement? So, you know, you review the existing covers, review the death and service, life cover for your spouse is a big one. Do you need to take out joint cover? And then inheritance tax, because as we all know, property prices, the way they're going in this country and the thresholds in this country, very often it can trigger a very serious inheritance tax bill for our clients, and particularly for their children. So again, something that we can talk to you about in detail, but usually we link meeting 1 and meeting 2 before we get to retirement age, because, you know, our benefits will stop when we retire. Okay,
brilliant.
So moving on, I suppose in relation,
because I had a question here, Ellen, with Brian from Revenue. He was saying he'd like to retire early, but like, you know, he won't have the full service. So what does that mean for Brian?
Okay, so Brian, yeah, I mean, it's a great one, and I think, you know, yourself and myself, Claire, we're doing this quite a long time now, but between the two of us, and like probably 80% of people that we talk to have some kind of shortfall in service. Okay, and there's various different reasons, and I'm going to walk you through these, guys, you know, because again, everyone is different. But look, if you started working late, you worked in the private sector, came into the public sector late, so you're never going to have the ability to clock up a full 40 years. And
even like people in education, you know, they're doing degrees and masters and stuff and traveling.
Absolutely, you know, and also as well, you know, to qualify for certain professions, there's a certain length of time that you have to study for and get experience in before, you know, you can start working at that occupation. But that's a really important one. Also as well, look, retire early, as you know, Claire, if I had €1 for everyone that said they wanted to retire early.
You want to retire tomorrow, Ellen.
Exactly. I'd be a very rich woman, but it's a huge one. And again, as you mentioned earlier, I think the pandemic has really put a focus on what's important to people, you know, and if retiring early is something that you feel is an option you want to look at, absolutely look at the option, do the maths, do the figures, and see is it workable.
And I think as well, Ellen, like what we see is there's a lot of professions that, you know, it's not practical to be doing it into your mid to late 60s.
Oh, absolutely. And you know yourself that there's some occupations that they're just so physical, or, you know, very demanding, or working in very stressful, pressurized situations. And all of that will have its natural wear and tear physically and mentally on the individual.
Yeah.
You know, I see a lot of it in within, you know, the HSCs.
Hospitals, the guards, you know.
Guards, absolutely. Physiotherapists, very physical job. And, you know, I rarely see physiotherapists working on past 60, you know, so again, have a think about it from your own situation. But that's a hugely popular one, particularly at the moment. Working abroad, you know, again, you see a lot of this with, say, the likes of doctors that would, you know, have taken time out and have to work abroad as part of their training package. A
lot of the nurses, don't they go abroad as well?
They absolutely do, you know, but all of this, any time out, any, you know, time that you take off from service is going to have an impact on your service when you get to retirement. Also as well, job share reduced hours. And again, look, this has a huge impact on the end result. So, you know, if you job shared, Claire, for 10 years, you're only credited with 5 years equivalent service to your pension.
And I think we always say this, it's no coincidence that like 70% of our clients are female, because they have taken the time out for the family. And no, look, it's not always female, you know, more and more men are doing it too. But, and you can't get the time back, but it definitely impacts on your service.
Absolutely. And you look, historically, that's just, you know, the way the demographics went, but 100%, any time off, guys, any job shares, 4-day week, 3-day week, it's all going to eat into your service when you get to retirement. Also as well, career breaks are a big one, you know, so any time out is going to eat into that service. And then also non-pensionable employment.
What does that mean?
Yeah, this one is a strange one, because I suppose if you're looking at, you know, as Colin was saying, how your pension and lump sum are calculated from your employer, it's usually based, for most occupations, it's usually based on your basic salary. Okay, so I'm just going to throw out an example, Claire. We would deal with a lot of medical scientists, just for example,
okay.
and there's a facility there for them to do a lot of overtime, particularly now with
the
pandemic,
labs
you know.
are busy. They're do not call at the weekends, nighttime.
Absolutely, but all of that overtime is non-pensionable. Now, what I mean by that is, let's say, Claire, you're working in St. James's lab and you're on 50,000 a year, but you're doing, you know, 20,000 in overtime annually. Now, if you look at the example that Colin used earlier, that, you know, you retire on 50,000 and you have your full 40 years service done, you should receive 75,000 from St. James's Hospital as a tax-free lump sum. Okay.
Yeah.
Because the hospital are not factoring the extra earnings into consideration.
Yeah.
Revenue will allow you to use all of your income once it's
been taxable.
Absolutely.
Yeah.
So in that situation, Claire, you could fund for an extra 30,000 in your tax-free lump sum. And when you get to retirement, if you fund it for, like, say, through an ABC, that's a tax-free lump sum that you're going to get out.
Brilliant.
So
yeah, and I mean, that medical scientist, they get a lump sum, you know, reflective of what they were earning and working, and because, you know, a big bugbear for the people that do the overtime and stuff, it's taxable. They take the pension levy off it, but it's not reflected in your pension.
Absolutely. And again, you have the facility to use tax relief on all your income, which is great.
Brilliant.
So any reliefs that we can utilize, honestly, utilize them if it makes sense.
And I think, you know, before people meet with one of our financial planners, we'll always say, look, you know, get a pay slip over to us. If you you know, what did you earn in the last 10 years, you know, so we'll try and get as much information as we can from the client to give them a good picture of what they can do.
Absolutely. And look at, guys, you know, if the lump sum is all, absolutely, it's such good value for money because of the tax relief, be it the 40% relief or the 20% relief, and do it before you retire is our advice on that. So I suppose, look, again, parental leave, extended maternity leave, you know, so any time out, you know, 4-day weeks, or, you know, taking the 4 months at the end of your maternity leave, all that's going to have an impact, guys. Again, just to be mindful of it. So I'm moving on.
Yeah, like with Deirdre, we had Deirdre is a nurse in the HSE, Ellen, and she's asking about buying her training years. So what does that mean? I suppose, what options have people got if they want to make up for shortfall?
Okay, so training years, again, it's a great one to utilize. So purchase back your temporary and training years. You know, you see a lot of this with nurses, don't you? You know, they physically worked in the hospital, but they weren't students. They were students, and they weren't making their superannuation contribution. But because they've actually physically worked in the hospital, they have an option to buy those years back. It's usually between 3 to 4 years. And honestly, guys, if there's anybody that has something like that they feel lurking in the background that they haven't bought back yet, seriously look into it, because it's really, really good value for money in our experience, you know, to do that. And it's going to add to your pension, and it's going to add to your lump sum. And also as well, there's tax relief on buying these years back as well. So honestly, I would look into it. The other form of purchasing service is notional service. So again, Claire, to use the example, you worked for 10 years, you job shared, you're only credited with 5 in your pension, but you have the option to buy those other 5 years back. So it's notional service that we haven't physically worked. And again, guys, there's a couple of things to think about on this. Absolutely, it adds to your pension, it adds to your lump sum. You know exactly what you're going to get, you know, in terms of monetary value when you retire. Couple of things to think about. In our experience, feedback that we're getting from clients, it can be quite expensive. So again, just to stress test that against what it's going to actually give you when you retire.
And I think if you're on the A rate, it's not 100% certain what you're buying back, because as the social welfare changes, the buyback changes. So, but look, it's something that we can discuss at one of the reviews with the clients.
Absolutely. And again, guys, it is an option, and it may be the option that suits you. But the thing is to do the sums on it is our advice.
Very good.
The next option, obviously, is, you know, where we would step in, which are purchase of additional voluntary contributions. Okay. Now, guys, what I'll say from the offset here is, look, they don't suit everybody, but if they do work for you, they can work very well. And as you know, Claire, look, we've clients paying into these plans for various different reasons. They could be using them to, you know, just max out their lump sum. They could be using them to, you know, add value to their pension income, or they could be just building up an extra fund that they want to use in retirement. Or it could be for all three. It just depends on what your own situation is and your own objectives for retirement are. But again, we'll walk you through whether this is a suitable product or plan.
And I think as well, what's important, and I've always stood by, is that we walk you through the pros and cons of any decision that you're making. So it's eyes wide open. Like.
Oh, 100%, you know, and look, there's full disclosure on any of these guys, you know, where the money goes, how it's invested, charges, etc. And it has to work for you guys, you know. But what I would say in addition to that is that it can work very well if the right plan is in place. Okay.
Right.
The next thing is do nothing. And that's not me being facetious. It's really, I suppose, doing nothing sometimes is the best plan, because if ABCs are not going to work for you, or buying service is not going to work for you, and you have your full 40 years done, you're completely happy with your lump sum, completely happy with your pension, doing nothing is very often the best plan. All right.
And actually, so we had a question from Liam in Westmeath County Council. So he was just asking about how he could build up ABCs, Ellen. Okay, let's click on here. And I'm just going to, you know, walk you through a couple of slides, guys, because, you know, really from everyone's point of view, we'll get into the nitty gritty with you and the specifics and the figures and what your own limits are. But this is just an example. Look, how you can build up your tax relief done at source through your employer, and that is sent to, you know, whichever particular scheme you're attached to, and that's held in trust for you until you retire. Okay. And then the second option is that you could make annual lump sums into your pension plan. Okay. So again, this is quite popular for somebody that, you know, is in the run up to retirement or funding for a last minute lump sum to increase their tax-free lump sum. And some people like actually doing lump sums at the end of every tax year. You know, it suits them better. Yeah, but I think the thing that needs to be, you know, stressed, Ellen, is that there are closing dates and times when you have to get the payment in and you have to make your rebate by. So we'll obviously give you step by step, but there's, you know, there are things to be aware of with that. Yeah, and as you know, Claire, every kind of September, October is our lump sum season. So yeah, 31st of October from. Yeah, we all need a holiday in November. But yeah, it's really important, guys. These deadlines are there, and you know, if we miss those deadlines, you know, we might lose out on the facility to getting your tax back. Yeah. But also, it's crucially important if you are doing a last minute lump sum that it needs to go in before your retirement date also. Okay, right. So that's crucially important. But again, we'll talk to you about your own situation. So this is just, look, a quick example as to, you know, by making a pension contribution, how you can turn 20,000 into 28,000 via an ABC. Okay, so if it's a case that, you know, you're making a contribution, 20,000 goes into an ABC fund, there's a rebate. Now this is assuming 40% tax bracket, guys, okay, and that you're entitled to 40% tax relief, 8,000 tax back, 28,000 invested. Okay, so again, very, very simple way of putting it, but we'll get into the nitty gritty. Yeah, and go through all the bits and pieces. So absolutely, but again, it's just an example as to how it can work. Great. And then also as well, look, how can you build up 100k in ABCs over 16 years? So this is just, you know, a very common example of our clients. So your contribution, 67.63 per week from take-home pay, so that's your contribution. Tax relief at marginal rate, so your total cost is 56,263, marginal rate 37,508, and then growth estimated at 3%. I think what's important, Ellen, is had the person not done this, they would have, the 37,500 is paid in tax, it's gone. It's gone. Again, down the revenue dark hole. So again, you know, you need to make sure that this is going to be, you know, workable for you. It's good value. It represents good value to you. And I suppose considering, you know, the way deposit rates are at the moment, it's great value for money if it works. Yeah. Okay. But look, the key things are you can't get at it until retirement, you know, so it is your war chest
for down the line.
Brilliant.
So then moving on. Yeah,
so
I mean,
Ellen, what are your couple of key points for our attendees this evening before we move over to Neil? So thanks very much for all that. That's been really helpful.
No problem. I think the big thing, what I've learned over the years working in IPF, is that if a client has a very clear plan and thinks about what their own objectives for retirement are. Now, that could be, I want to stop at 60. It could be, I want to have big pockets. I want to go to Vegas every year for 10 years. Whatever your objectives are, guys, have a think about what you want to achieve for retirement, the lifestyle you want, the income you want, and what you need to do to get all your ducks in a row before retirement. So the planning process is really key. And the last point I'd throw out there would be get advice. Financial advice is really, really important, you know. So again, you're keeping your plan on the track.
That was great. Thanks so much, Ellen. So now we're handing over to Neil. This is meeting 3. So whereabouts are we now on our retirement journey?
Thanks, Claire. Evening, everybody. Great to have you all in attendance with us this evening, and I find this evening very informative. I'm now going to bring you through the at retirement stage of your financial plan. And this is where we review, we revise and implement your own financial plan. So the hard yards have been done, as Ellen said there, the war chest has been accumulated and you're at retirement stage. So what are your options and what can you do?
Because I think we had a question from Deirdre in the civil service, Neil. So she just asked, like, how do I best manage my AVC when I retire?
It's a good question. It's a good question. It's one we get a lot. And Deirdre, what your options, you've got a couple, okay? But what we will always look at doing first is with the funds that have been accumulated, as Colin mentioned earlier on as well, maximize your tax-free lump sum. I can't stress that enough, okay? So maximize your tax-free lump sum. Now, there are limits. There are certain different people have different sort of situations and service and how much they've accumulated. But what we will always do is maximize the tax-free cash first.
And I think just before we jump on there, Neil, there might be a bit of work for the client. Like they might have to go and get 10 years salaries and get overtime, you know, so there will be like a body of work for them to do if there's ways of improving the lump sum.
There is, but it's absolutely worth it. And it can be, as I said, you might need to go back and get all P60s or write to the employer, get previous past salaries, etc. But it's worth it. It's worth it, absolutely. If you can, and again, as Ellen used the example later on, if you can put money in, get a tax rebate back on it and get the balance out as a lump sum at the end, similar to with your AVC funds, if you've fund accumulated, absolutely, it's worth it. We can go down that road.
Okay, so Deirdre's gotten her tax-free money now as best as she can. Okay, she has a balance. What are her options, Neil?
Okay, so Deirdre has 3 options with the balance, okay? So I'll walk through each of them, and I've got a slide in a moment which will compare a couple as well. So firstly, what we can do is you can purchase an annuity, okay? An annuity is effectively a pension for life, similar to what Deirdre would have at the moment, say from her local authority scheme. So when she retires, she'll have a pension from work, and that's what an annuity is, okay? It's a pension, it's a fixed amount, and it's paid.
Okay.
The second option is what's called an approved retirement fund, or an ARF, or an ARF. You hear it called different things, but effectively what that is, it's the balance that's left over that's drawn down in a way that Deirdre would like to have it drawn down. She and it can be paid monthly, it can be paid quarterly, it can be paid half yearly, or it can be paid yearly. Or the third option is what an individual could do, is could take it as a taxable sum. Now,
do we see much of that, or?
Not really, Claire, not really. In practice, we wouldn't see a lot of it. It's probably like a 1 in 100 case where we would see it, and where it would be is
you hand a lot of the money back to the taxman, basically.
Correct, and you build all this tax relief up and handed it back. But where I've seen it being used is when the fund value is actually quite low. So after the lump sum has been paid, the tax-free amount is being paid, there's a balance that's left over. Yeah, and it's not actually enough to set up an ARF, and it's too small to be an annuity. So the person may actually have to take it as a tax.
Perfect. Yeah. So Bernard in the civil service, he was wondering, like, he just wants some more information about the approved retirement fund. I mean, Neil, percentage wise, what percentage of our clients will opt for an approved retirement fund if they can qualify for it?
Yeah, at the moment, we're talking 97%. We're talking 97%. It's something, and it's a lot of the reasons why is the current climate, to be honest with you. Now, what I've done here is I've broken down a couple of reasons why an ARF can make sense. And I've got a slide at the moment which compares it against the annuity. So an approved retirement fund is basically a flexible arrangement that allows you to remain invested in funds after retirement and withdraw the money as and when you wish. Now, Also, the investment growth is currently tax-free. Okay.
Okay. So, because I mean, if they invest their money anywhere else and it's not an approved retirement fund, it's subject to dirt.
And exit tax, yeah.
Oh, yeah.
Yeah. So now that's obviously things could change.
Everything can change, but at the moment, yeah.
But like a pension fund. So when pension funds were accumulated, there's no exit tax or dirt tax on them, and tax relief was built up with it. So it can be a very prudent way of planning. Withdrawals are taxed, okay, as Colin mentioned earlier on, as Ellen mentioned earlier on.
Unfortunately, yeah.
Yeah. Now, around this, okay, withdrawals being taxed, as Colin mentioned earlier on, and he had a slide up which had tax bands and showed, depending on people's circumstances, if you're married, widowed, depending on credits, etc. With an ARF, you can be quite clever a little bit with your drawdowns, and you can keep the amounts below lower tax bands.
Mm-hmm.
So withdrawal to keep it below the certain thresholds. Now,
and I think but I think the IPF financial planner will help the client to look at that, and we always call it to try and box clever, I suppose.
Absolutely, yeah. Now the deemed withdrawal, okay, what that means is though from
what does that mean?
Yes, because I know. So basically, the deemed withdrawal is that an amount from an approved retirement fund will have to be paid somewhere over the course of the year. If you're between 60 and 70, it's 4% and 5% thereafter. Now, if you've decided or you haven't let the insurance company know how much you want to withdraw, they'll actually take the 4% out and you'll actually pay the tax in your fund, or the balance will either remain in it or will be paid out. You'll have to make that decision yourself.
Mm-hmm. And it's funny, Neil, though, I think we've settled, I think we've about 3,500 of our clients have retired. And it is one of the best parts of our job, let's face it. But with the approved retirement funds, they can choose monthly, quarterly, half yearly, yearly. Like I know clients that say to me, look, January, I've got the VHI and the car tax, and and they can plan those payments around the bigger bills so it doesn't interrupt their normal pension.
Absolutely, Claire. And as you said there, with the flexibility of the income is something that's a big plus for the ARF. Now, I just want to sort of do a bit of comparison towards it, okay, and just to explain it. So
yeah, and like everything, Neil, like we've been saying throughout the webinar, there's pros and cons to everything, I suppose.
There is, okay. So with the flexibility of the income, on an annuity, there's no flexibility, okay. So the flexible side of it, it's sort of taken away with that. Now, in saying that, okay, no flexibility in income, one of the drawbacks at the moment around the annuity side of things is the rates are so low. Okay.
So what does that mean? Just for the layman?
Yeah. So what that means is, as deposit rates are low at the moment, and as the shifts at the moment in the bond market and the volatility that's happened over the last 10 years, especially even recently with the equity market, and one of the things we mentioned a couple of times, with people living longer in retirement, annuity rates have drawn back, and what it means is, and again, use a round figure here, if you've got 100,000 that you've given to the life company, you might get quite a low rate, and what that will then mean, you have to live for 50 years to break even.
And we looked earlier on that 20 years is the average in retirement, so
it mightn't be the most prudent option to go down the road of. With the ARF, again, it will be continue to be invested. Okay, so similar again, to use the pension as an example, as people would have built up their pension funds, to see how there are ups and downs, and there are going to be times when funds will go up and will go down. But over the long term, typically they work out quite well. So with that, if your fund is making some form of growth and you're withdrawing money out, it can be sort of washing its face a little bit sometimes, depending on how you're withdrawing.
Right.
But with an annuity, there's no potential for growth. You're stuck. You've got your fixed income. It's put inside.
Yeah.
One of the other points as well, I'd say, around.
And I think the next point you're going to make, Neil, is in my experience, one of the most important things for people when they come to retirement.
Yes, an inheritance. So leaving an inheritance. So with a fixed income, as I'm saying, it's not guaranteed for a period to be paid out to a dependent, because you have to guarantee it, and if you guarantee it, the rates will come down lower. But with a pot of money, if you think the ARF like your pot of money, that's an asset. It's yours. You've accumulated it. If anything happens to you, it's your next of kin's. So
if I have an approved retirement fund of 200,000, age 60, and at age 61 something happens to me, it doesn't die with me, it goes to my estate, which is correct. And I've gone to the trouble of building up that money. So yeah, brilliant.
And it's a very again, go back to this word that Colin was saying about financial plan. So it's a very prudent way of having an asset inside your financial plan. But if you think about it, when it was generated, when it was accumulated and amassed, it was tax deductible. So if you built up 100,000 hypothetically, with growth and with tax relief, might have cost you about 50.
Yeah.
So by getting good advice, as Ellen has said, and as my advice would be as well, always get advice and looking at these things down the road.
Okay.
Now, a couple of other points I'd make about the ARF is that you're not stuck in this. Okay, so with an ARF, unlike an annuity or a taxable lump sum, you can still buy an annuity later on. So, for example,
so a year in with my 200,000 approved retirement fund, I'm kind of saying I don't really like having this money coming in and drip fed to me.
Yeah,
like I could convert it to a pension.
Correct. So,
okay, great.
There's a couple of reasons that, again, I've seen it, where volatility. Okay, people are worried at the moment, can be worried at the moment with volatility, and they thought initially, it's like, oh Jesus, I think that was a good idea if we go down that road, but now they've seen the shift and they want to fix their pension. You can do it. But if you've gone down the annuity road, you can't go back.
You can't go back to that. Okay.
Or if you wanted to take a lump sum out later on, so as we said, say help the kids out with a wedding, or help towards a property purchase somewhere down the country potentially, or even nursing home care down the road. With an ARF, you can take more sums from it. Like you can take like taxable lump sums from it.
Okay.
Again, with the annuity, you can't. Again, it's stuck. It was what you decided at the time, and it's fixing that rate.
Very good.
The flip side of that, though, as well, as I mentioned, is the investment risk, and it could run out. Okay, so with an ARF, over the
so
course,
if I was taking 15% of it every year and it wasn't earning any interest, and it could be gone in my 70s.
Correct.
Okay.
Just to be aware of that as well, and it's something we discuss with our clients at all stages across the glide path process, but it's something to be really aware of.
Okay, so final words from you, Neil, before we hand over to our final speaker.
To be honest, I'm going to sound quite boring with this as well. It's something that we've all said, but it's really about getting good advice. Honestly, I can't stress that fact enough. And the earlier you think of things like this and think of, okay, what type of retirement do I want? How much, like Colin has said earlier on, the four-week rule, plan for it, have an idea how much you want of an income. And then once we know what the tangible for you guys, what you want, we'll be able to put a tailored plan in place for you.
Brilliant. Thanks for that, Neil. Now, just to remind everybody, we have our €150 all for one voucher competition at the end of the session after Owen's talk. So hang in there. I hope you've been all paying attention. So Owen Dwyer, thanks very much for joining us this evening. As we know, you're our founder and our CEO. So you have joined us this evening, and what part of the retirement area are you going to cover, Owen?
Well, as you and your colleagues very kindly pointed out, Claire, I'm coming to retirement myself. And you went through everybody's years with the company when you started, but you didn't mention mine.
I know yours. I think you're being
kind to me. But I actually have 37 years experience in the business, and Claire has given me an extra 3 years professional added service for good behavior. So I'll have the equivalent of 40 years in October. Look, what I'm going to talk about is a reality that's facing all of us when we get into retirement, and how we can deal with that reality and how we can best manage it. And there's a couple of things that we
I had a question from Ian in the civil service, Owen. So he just said, like, how concerned should I be about inflation, and can I hedge against it? So I thought that was quite a good question for what you're going to talk to.
Yeah, well, the answer to your question, Ian, is you should be concerned about it, but you can manage it. But you need to pay attention to it, I suppose is the best way of putting it. So you have a double whammy here, don't you? I mean, you've got deposit rates are very low at the moment. Collie was giving us a demonstration earlier on, and I think Collie might correct me here, but in some institutions they actually charge you for looking after your money now, don't they? Rates
they can indeed, yeah.
Some of the German deposit managers are charging people for the security that comes with it. But look, be that as it may, we all know at this stage, it's old news that you used to get fairly decent deposit rates in this country, and now they're pretty poor. They're way below 1%. And the people watching this know that, as we saw from their chat room answers to your question earlier on, Claire. You have a double whammy because on top of your poor deposit rates, you've got inflation, which is what Ian was asking about. 2019, that was the rate. 2008, that was the rate. 1981, it was 20. We know this is around the time I started working. Inflation was very high. Anybody want to take a guess what it is for 2021? Not the chat room now, just the panel.
I was wondering if you were asking us.
No, just to see. Anybody know?
It's got to be upwards of, I don't know, 6%.
Very good, Colin. Yeah, it's gone up to 5.5% now. Inflation has gone, it's kind of gone back up again. So what does that mean to us? We were listening to things about inflation for years, and you know, a lot of people wonder,
like should we care?
Do we care? And if we stay awake long enough, should we care? Well, look, you should care. You know, this is what happens to your money over 10 to 15 years with inflation. And we've given a couple of examples there, 2, 3, 4, and 5% inflation over this period of time. And you see, if you've got 50,000 euros on deposit in any kind of, say, deposit account, and you're not getting any interest on it, then after 10 years, the purchasing power of that is 41,000. And after 15 years is 37,000. So you're hemorrhaging value the longer you leave it on deposit, just purely based on inflation. And you can see there that if inflation on the other end of the scale, if inflation is higher, then obviously your money is going to be worth a lot less. So the option of leaving it under the mattress doesn't really make sense anymore. So what can you do? The question is, like, if I can't leave it on the deposit, I can't put it under the mattress, and you know, what the hell am I supposed to do with my money? So let's have a look. Okay, these are 6 bits of advice. There is no one easy answer to this. Nobody knows. If I could give you the correct answer to that, I'd have to have a crystal ball. So as with a lot of things to do with retirement and financial planning, if you do a lot of the right things, you have a much better chance of getting a good result. So over the years, the experience I've had talking and dealing with people, and even with my own pension, these are the pieces of advice that I'd like to pass on.
Okay, great.
A couple of these have been mentioned before, but planning is really important. I think you should sit down with your partner or with you know, somebody that you trust, and write down on paper what you're going to need money for when you retire. And when you're going to need it. And I'm not just talking about your income, which is being mentioned, but you may have events coming up like a child getting married, or you may want to clear your mortgage, or you might have other you know, plans, like you might want to do a world cruise. I think somebody mentioned earlier on about going to Las Vegas. But whatever it is, it's your money and it's your business. But write it down and try and cost it as much as possible. And also look at you know, fill out Collie's budget calculator and find out how much it's going to cost you. So do kind of a little reality check with yourself about what you're going to need. Okay, making sense so far?
Yeah, sounds good.
The second thing I would advise you to do, and this is where retirementclaims.ie comes in, it can help you with this, but gather together all of your assets. It's not just pensions you have, but when you get to be an outflow like me, you may have an investment property, you may have other savings. Your spouse may have other savings. So accumulate and get a clear idea of exactly what you have in terms of your retirement assets. In other words, what raw material do you have to work with going into retirement? So
Brilliant.
that's, you know, that's really important. Don't go into retirement blind and hope for the best, because it could cost you an awful lot of money, this lack of awareness. The third thing I'd say is to assess what you can do between now and retirement if you haven't yet retired. And again, Ellen, you covered this really well, the different options people have. I strongly recommend that people avail of every tax break they have between now and retirement, because once you reach retirement, all bets are off. You're not allowed to do that anymore. So you might as well use them before you go. God knows we've all paid our share of tax before we reach retirement. Don't leave anything on the table would be my advice to you.
Absolutely.
If it's at all possible. Now, use buckets. Now, Claire, this is not you in your early 20s. It's not the type of buckets I'm talking about here. I'm talking about financial buckets. Okay, financial buckets. So you've got short, medium, and long-term needs as you go into retirement. And you need to treat each of these periods differently. Okay, you need to break them down because they all have different requirements. So for example, your short-term needs. So this is what you're going to need cash for in the first 5 years of retirement. That's your short-term bucket. And you should only put that money on deposit.
So you have to be able to get your hands on it. So
you need to be able to get your hands on that money, and you're not really interested in making interest on this money. So the bank is probably the best place for this. Don't invest money that you're going to need in the first 5 years. All right.
Okay. That's great advice.
So that's the first thing I'd say, and it's going to be different for everybody. I mean, one of the things that Jacinta inside was saying during the week, Claire, when she was doing a little presentation on this, is that, and she made the point, I know we keep saying it, but everybody is going to be different. Some people say you should have a year, you should have 2 years income, but it depends what you need. So there's no rule of thumb. So again, take financial advice on it. And part of our consultation process is we would always ask you to be clear on that, and we'd always probably add on about 20%, wouldn't we? Just definitely. Yeah. So we come to your medium bucket. Your medium bucket. I don't want to sound too much like Goldilocks here, but this is your medium bucket, and your medium is from 5 to about 15 years is your medium term. And in my view, that should be invested in a medium to medium risk investment bond type of a thing, where you'd have a mix of assets. You'd have some shares, you might have some cash, some government gilts, but you've got exposure to medium level risk. And you may have, a property in there, that you're getting an interest from. It's still a medium risk thing. It's not.
And you hope to beat that inflation that we were looking at before.
Absolutely. And a property is not short term, because, if you have to sell the property, it's going to take a long time.
Oh, yeah.
It can be a good thing to have in a medium or a long term bucket. Your long term bucket, then you can afford to risk up on that. And we have these risk profilers where, your attitude to risk is taken into account. But bear in mind that the market doesn't care what your attitude to risk is. The market's going to do what it's going to do. So you need, in my opinion, and if you look at historically what markets have done, you do need to risk up for the long term. You need to go medium to high risk, because if you do have dips, and you'll always have dips in any investment, you've got time to recover. But over the long term, a little bit more risk will give you a bit more return.
Okay.
Now, where the bucket concept comes into place is that if your long-term bucket does particularly well, then you can tip that a little bit into your medium-term bucket. So you have more in your medium-term bucket. And then you can tip your medium-term bucket, if that's doing well, into your short-term bucket to give yourself more money to enjoy in the short term.
Yeah, it's a good way of looking at it.
And likewise, if the opposite happens and markets go badly, well, then you know that you can't take money out of the medium or the long-term bucket. So you have to live within your means, but you're not dipping into resources you're going to need down the road.
Okay.
You're cutting your cloth to meet your measure. Does that make sense?
Yeah, no, it's very good.
Okay, so your review then, which is point number 5. When I was a younger guy, I used to think that life kind of stops when you reach retirement, that it's all one big long period of your life that doesn't change much. But now that it's on top of me, I realize, as most of our people that are watching here tonight, most of our clients will understand, that things can change in retirement every bit as much as any other period in your life.
Yeah, it's another phase of your life,
It's another phase of your life. You could have a child who has an accident, or it could be something very positive. You could have somebody is getting married, and you didn't think you needed money, but now you need money. So, or you thought you needed money, but now it turns out that the bride's father is going to pay for the wedding after all. And you don't need to dip into your short-term bucket as much as you thought, and you might want to tip a little bit the other way. So, and I know this is something you're always saying, Neil, is always, work the plan. You don't just make a plan and forget about it. You have to review it every year. And again, Claire, you're going to talk about the retirement help desk. That helps our clients with that. Now, this is something I'm going to disagree a little bit with you on, Colin. You said earlier on that your need for life cover isn't as much when you reach retirement because your kids have grown up. And you made the point that you may have an elderly relative that you might want to care about, but that elderly relative might be you. Like you might love yourself. So make sure that your spouse is properly covered so that you're not vulnerable in retirement. Because without stating the obvious, and I'm, I suppose, the only one on the panel that can afford to say this, is that if you haven't died by the time you reach retirement, the chances are you're going to die after retirement. And that's when you're going to need the life cover. So make sure that you're properly protected by protecting your spouse's life. And, you know, you may want to make sure your spouse is properly protected by putting some life cover on your own life. That's up to you, but for God's sake, look after yourself and make sure that you're aware of how the finances are working in your relationship, because a lot of spouses find they leave it to their husband or their wife to look after their money, and then if their partner, the partner who looks after the money, predeceases them, they're all at sea. They don't know where the money is. They don't know how to manage it. So make yourself informed. I mean, my wife's eyes glaze over whenever I start talking about money to her, but I make her listen because it's important. Because I'm definitely going to predecease her. If I don't, she'll kill me. The point is, make sure you think of yourself going into retirement. That's not a selfish thing to do. If you don't look after yourself, there's no guarantee anybody else will. It's what I would say to financially from that point of view. Now, there's only one more thing I want to mention, and nobody has mentioned the two bugbears that I've been listening to from clients all my life.
Okay.
We haven't really got into detail about charges and fund risk.
Yeah.
You know, all of you know from talking to clients that the big you know, questions people have is about charges and about fund risk. And people don't want to pay charges, and that's no surprise. That's human nature, and they don't want any fund risk. And you know, I've nothing to lose at this stage because I'm off in October, so I've no axe to grind here. But you need, I'm saying this to the people out there, you need to understand there has to be charges because we can't function as a private company without charges. But we are transparent about them. So just make sure you're clear on the charges before you go into any contract. We'll tell you about them. And if you don't want to pay the charges, then you can't really avail of any service in any industry or buy any product from any product provider. But just, you know, be sure that you make yourself aware of it. And you also have to live with the fact that there's always risk in fund management, in investment. So I'd love to be able to say, oh, we've got this fund, there's no risk attached to it, but you have to manage that risk. And we're in a very risky period now. There's a war going on over in Europe, and funds are volatile. And you know, I've seen a lot of this over the year, a couple of Gulf wars before, and we've had a couple of recessions before. It's very important not to panic either before or after retirement. You guys remember during the recession in 2008, people lost a fortune. Clients of ours lost a fortune because they switched out of shares and into cash at the wrong time. We begged them not to do it, but they didn't listen to us. So if you have an investment, you have to understand that you have to detach yourself emotionally from that investment and just allow it to do its thing. And the investment will always recover in time. As a matter of fact, there was a bit of a dip when this Ukrainian stuff was starting, and there's been a bounce since that, so it has already recovered. So never panic when it comes to your money, never make an emotional decision, and allow the investment to do its thing.
That's great. That's brilliant advice. Okay. Listen, thanks so much, Owen. Okay, so before we get to our competition, there's just two more things that I'd like to show you. I'm clicking here, Sarah. Great. So we discussed a lot about retirement this evening. What we've also always ran after our retirement seminar is an investment seminar. Okay, so I'm delighted to say we did one of these last year on the webinar, and it was really well received. We have a really good lineup. We've got James Forbes, who is from Goodbody Stockbrokers, really knows his stuff. And we've Stephen Dixon from New Ireland have agreed to come on and do a webinar, a free webinar for our clients around investments. So if it's a thing, you have some money you'd like to invest, or, you know, when you retire, you'd like to look at doing something with some of your gratuity. The questions you need to ask is, how much do you have available? What's the time frame, as Owen was discussing a few moments ago? What would you like to achieve with the lump sum? Will you need to take anything from it? Will you need any access to it? So these guys really know their stuff. So that's on the 27th of April at 7 o'clock. Sarah will be sending out invites to everybody. But it's a free webinar, and it's access to two of leading experts in the industry that normally wouldn't be available to. They only deal with brokers normally, so it's really, really good. Now, last, and as Owen mentioned as well, so if you're a client of IPF, when you retire, that's not the end of the road. So as we said, we've 3,500 existing clients, and we have a dedicated retirement help desk.
Who are retired, Claire? Who are retired? 3,500 who are retired.
Retired, sorry.
26,000 clients, just to be clear.
Sorry, I thought I said retired.
Yeah.
So our retired clients can access this help desk Monday through Friday. They're the typical type of questions that we get to the help desk. So look, that's a service that we provide, and we're really proud of it. Okay, are we all ready for the question time? Sarah, are we opening up the chat function?
All good to go. So we're going to go fastest finger first. So whoever's first in.
Okay. Oh, what was Ireland's rate of inflation in the year 2021, Sarah?
Yeah, people are right in there. Wow. And people were listening. We're getting a lot of correct answers here. So let me just see who was first in. So now I think I've John Dwyer, it looks like. So well done,
No
John.
relation. No
No
relation.
relation. Oh,
No,
no.
actually, yeah.
Well done, John. I'll split it with you later. Where is John from, Sarah? Just in case he is related.
I can't see it here now,
Okay.
but we'll double check and triple
Okay,
check. Don't worry.
okay.
Well, look, once again, thanks to all our attendees for coming along. I hope you found it very beneficial. We will be sending on the slides, and if you wanted to have a consultation with one of our advisors, just let us know. And thanks again to all our panelists, and also Sarah, our producer, for putting this all together. I hope you found the evening very enjoyable.
Claire, just one thing there. There's a couple of quick questions, if you don't mind me asking, that clients just in the chat room. One chap there, what happened to ARFs? They're gone.
Oh, yeah.
They're gone. The government did away with them.
Yeah, good question, actually, yeah.
Yeah, and another one was, what is IORPS? So IORPS is just, it's the name McCourty, you know more about this than I do, but it's kind of a European directive reviewing how pensions work and so forth.
It's about the funds area, Neil, wouldn't it be, like, and just what you can invest your pension and so on and so forth in?
Yeah, doesn't really. I don't think it makes any real difference. Yeah.
Not for the main
group schemes.
Yeah.
If it does impact upon anyone in here as part of the consultation process, we'll be able to speak to them about that, but it's very rare that will come up.
Great.
Okay.
And I think we found out that John Dwyer is from Offaly.
He's Offaly. No, I don't think he's any relation, but he sounds like a lovely fella.
Great. Okay, thanks very much. Good evening, everybody.
Good night.
Thanks, everybody.
Bye, everybody.